By the end of this episode, you will be able to spot a Twin Peaks divergence on the Awesome Oscillator and catch a reversal before the candle even closes. We are talking about the double top and double bottom setup that Bill Williams himself used to filter out noise. You will know exactly when to step in front of the move, not after it. This is the difference between buying the dip and catching the knife. Most traders lose because they chase momentum. They see green candles and jump in, only to get stopped out at the exact top. The problem is not your entry signal, it is your timing. The Awesome Oscillator was built to measure the force behind the move. When that force weakens, price reverses. If you are a swing trader on H1 or H4, or a scalper on M5 and M15, this removes the guesswork. You stop asking, is this the top? And start asking, where is the second peak? This is for anyone who has stared at a chart for hours, waiting for a sign. It is for the trader who knows support and resistance, but still gets faked out. It does not matter if you trade forex, crypto, or indices. The logic is universal because it is based on momentum, not the instrument. Let me walk you through the exact steps. First, you need the Awesome Oscillator on your chart. It is the histogram below the price, with red and green bars. The AO is simply the difference between a 5-period and 34-period simple moving average on the median price. Why does this matter? Because it smooths out the noise so you compare medium-term momentum against the short-term. A green bar means the 5 SMA is above the 34 SMA. A red bar means it is below. That is the base. Do not trade anything until you understand that. Now the setup. You are looking for Twin Peaks. That means two highs on the AO histogram that are roughly equal in height, separated by a dip in between. In a bullish scenario, you want twin troughs. Two lows that look similar, with a bounce in the middle. The key is the price action underneath. If price makes a higher high, but the AO makes a lower high, that is bearish divergence. The momentum tells you buyers are exhausted. Why does this work? Because the AO is measuring acceleration. A second peak that is lower means the push has less fuel. The market will reverse. Here is the order of operations. Step 1. Mark the first peak or trough. Step 2. Wait for price to pull back and then push again. Step 3. Compare the second peak to the first. If the price high is higher, but the AO high is lower, you have a bearish Twin Peaks. Do not enter yet. Wait for the AO to cross the zero line or for a red bar to close below the previous red bar. That is your trigger. The same logic applies for bullish twin troughs, but inverted. You wait for the green bar to close above the prior green bar. Why the wait? Because divergence alone is not enough. It tells you momentum is fading, but it does not tell you when the reversal fires. The trigger confirms the shift. I trade this on M15 for intraday and H4 for swings. On M5, the signals come fast, but you get more false ones. If you are new to this, start on H1. The higher time frame gives you cleaner peaks. Now, you need to manage the trade. Your stop loss goes beyond the extreme of the second peak or trough. That is a hard rule. If the price breaks past that, the divergence is invalid. Your take profit is the next swing point or the opposite side of the range. I use a risk-reward of at least 1:2. If you do not have that, skip the trade. That is discipline, not greed. Here is a real test I ran last week. It was Eurist on the H1 chart. The date was Thursday. Price had been climbing for 3 days, from 1.0850 to 1.0930. The AO had a huge green peak at 1.0910. Then price pulled back, dipped its toes below the zero line, and pushed up again to 1.0932, a new high. The AO, however, printed a second peak that was shorter by 23% in bar height. That is the Twin Peaks divergence. I waited for the trigger. The next candle closed red below the previous red bar. I shorted at 1.0928. My stop was 30 pips above at 1.0958. My take profit was 60 pips at 1.0868. The trade ran in 4 hours. It hit my target at 1.0868, capturing 60 pips. The cost was just the spread, about 0.8 pips, which is $8 per standard lot. The output: a clean reversal with no time spent babysitting the chart. File size: not relevant, but the mental load was 0. The price dropped exactly 60 pips and kept going, showing the divergence predicted the top. I missed the last 20 pips, but that is my profit target. No regrets. Now the honest limits. This is not a holy grail. Twin peaks divergence fails in strong, trending markets. If you have a parabolic move, the AO will keep making higher peaks. Price is not tired. It is just warming up. When that happens, your divergence will appear, you short, and price accelerates against you. The stop loss saves you, but the psychological damage is real. You will start second-guessing every signal. Second, the setup is rare. If you are scanning multiple pairs, maybe you get 2 or 3 good signals a week. If you want action every hour, this feature will frustrate you. It is a patience game. What else breaks? The trigger is not perfect. Sometimes the first red bar closes below the prior bar. You enter, and the market chops sideways for 2 hours. You sit in drawdown, watching the clock. That is not a loss, but it is a drag on your capital. Also, this works best on forex pairs with low spreads. If you trade exotic pairs with wide spreads, the stop-loss distance gets inflated, and your risk-reward gets skewed. Do not use this on news days. A high-impact event will blow through the divergence like a freight train. You should not use this. If you are a scalper on M1, looking for 5-pip moves, this is too slow. The AO is calculated on 34 periods, which on M1 is about 34 minutes of data. That is noise. You will get false signals all day. If you cannot sit through a 30-pip drawdown, skip it. This is a medium-frequency strategy. The obvious alternative is the MACD divergence. It is visual, similar, and built into every platform. The MACD also measures momentum, but it uses exponential moving averages, which are more reactive. In a choppy market, the MACD will give you more signals, and some of them will be winners. The one situation where MACD wins? When the market is ranging, and you want to fade the edges of a channel. The max faster sensitivity catches those wobbles earlier. It is less precise, but more frequent. If you are a high-volume trader, that matters. Today, open your TradingView chart, pull up the Awesome Oscillator, and mark the last 10 peaks. Just look at them and note which ones had a price higher high but a lower AO high. Do that for 10 minutes. Do not trade it. Just build your eye. That observation is the skill. Then, when you see it live, you will trust the trigger. Next episode, we are diving into the accelerator oscillator for detecting acceleration and exhaustion.